Hey gang, welcome back to your second period of your financial class. This is Investing 101, and today we're going to be talking about the homework from last week and respond to questions that have been asked since the last video. We're going to talk about what is the stock market from a very, very beginner's perspective and go in enough that you can actually understand the lingo, probably talk to people about it, or at least understand what you're hearing other people talk about. We'll talk about several securities, including indexes, stocks, mutual funds, ETFs, and then we'll get into several of the account types that are available, including several of the tax-advantaged accounts and why and when you would want to use them. So first, as a follow-up, last video, I encouraged you to visit RamseySolutions.com and find out how much you needed to save for retirement, both as a nest egg overall value and how much per month you needed to save. I hope you did that. We'll go through and see what that looks like now. So here we are at RamseySolutions.com, and if we go to free tools and retirement calculator, we can put in an email address and get into the RIQ tool. They don't even make you click a link in your email address. You just put it in and you're immediately here. And you state what you want to do most in retirement. I think this is honestly just for statistical purposes. I don't think this impact. In fact, I'm sure this doesn't impact the result at all. You put in what your annual income is today. Let's say you make, for a nice round number, $50,000 a year. Now, they want to know how much you need per month to fund your retirement dream, and this number is just your annual income divided by 12. So that's a reasonable place to start. But again, as we talked about last week, you should think about maybe you have fewer dependents in the home, maybe you have higher health care, maybe you have lower or no mortgage at all. All of these things can impact your retirement costs, but we're just going to go with the default for now. How many years until you retire? You can it's just a slider, and you can legally retirement age when you can start withdrawing money from tax advantaged retirement accounts is 59 and a half, as far as I know, for most accounts. And you might decide you need to retire later than that. A lot of people choose actually 65, 70 even nowadays. But we'll just take the default again. How much do you already have for retirement? Let's say we have $10,000 saved for retirement. And here's the RIQ. We're done. That was really easy. Right? Most of those numbers are pretty easy to at least experiment with and play with. This number is the amount in your nest egg, the perpetual nest egg balance that you need to have. This should never deplete, basically. If you have this much, then you can withdraw that $4,700 or whatever we stuck with as long as you're alive. To reach that goal, and that might seem insurmountable, you need to save $1,100 per month. Now, we will talk about ways to achieve that. Depending on your income level and your ability to save, that may or may not be feasible. If it's not, you can come in here and adjust it. You can say, okay, well, suppose I'm going to work for a few more years. And let's see. Okay, that brought it down to $875 per month if you can work longer. Another thing you might do is say, okay, well, maybe I can't spend that much. Maybe I can downsize my house and pay a smaller mortgage. All right, now we're down to $600. So you can play with these things. Notice too that there are some things that didn't ask you. What's the inflation rate? What kind of return on your investment are you expecting? These are numbers that they probably shouldn't be asking you because at this stage you might not know what to put in there, but you could experiment. Certainly some indexes, some markets tend to get 12%, so you could try 12% and boom, now you're down to $477. And then it gives you some interesting statistics here. So that's just a tool that you can use to get an idea. Again, I actually have a spreadsheet that I'll eventually share with you that will make it even more real. That's a very, very simple tool to get you started, but it is a fairly realistic one, so that's good. But moving on now. Just some general advice. Be one with your spouse or your significant other. Assuming you're married, sharing bank accounts, really doing everything together, considering having a a common goal for retirement, a common goal for saving and spending, really can make this much, much easier. You should absolutely start saving now. If you've got $5 a month, start saving now. If you've got $500 a month, start saving now. It's, as we talked about last week, it is compounding interest is powerful based on the interest rate and the time you have to wait. So the more you, and time is the one incredible factor you can control completely starting now. And give along the way. There is a great link which I will put in the comments or in the video description. It's an article with some research showing that people who give along the way while they are saving for retirement end up with more money, and some of the counterintuitive learnings from that. So try not to be miserly while you're saving. Try to give reasonably, and check out the article that I'll put in the video description. So let's talk about the stock market. And like I said, we're going to talk super basic language, but take you all the way to being able to carry on a reasonably intelligent conversation with someone about it. So it's a public marketplace for exchanging many kinds of securities, including shares of stock, and we'll define that later. But it's sort of like a store, except it's virtual. You don't walk into it, and you can buy and sell things. A share of stock represents partial ownership in a company. If you own 50% of a company's stock, you could, or more than 50%, then you control the company. But this is rare. Most, or perhaps all, I don't know, publicly traded companies on the stock market are so large, it's unlikely that any one person will have enough money to have 51% of it. Startups, maybe. But for our purposes, we don't expect to control a stock. We'll own a very, very piddly, tiny piece of a company. Segments are often represented by an index. So these are market segments like industry, medical care, those types of segments. There are indexes to say, hey, medical care in general, all these companies that are into medical care are doing well, or they're doing poorly, whatever. Private companies may have shares too, but these are often not on the stock market. Well, they aren't. So we won't be talking about those much. Stock market has hours of operation. It's all virtual, yes, but they open at 9:30 and they close at 4 o'clock Eastern Standard Time, and they are closed on holidays. And that's actually nice and useful because the day traders and people who work in the stock market day in and day out, they can have their weekends, they can have their holidays, they can sleep at night without worrying that the stock market's going to go crazy while they're sleeping. Companies always disclose financials just after market close for the day, perhaps to let everyone read it fairly before trading on an adjusted price. So for example, let's say Microsoft, every quarter they release earnings, just like Apple and Google and all these, every other company has to, that's publicly traded, is obliged to disclose things periodically. And when they do, people need time to ingest it and say, okay, Microsoft made X dollars this quarter, which is more than last quarter, but less than projected, etc. Whatever the things are, and think, okay, that means Microsoft isn't doing as well as I thought, or Microsoft is doing better than I thought. And so I'm going to buy, or I'm going to sell Microsoft stock. And so these disclosures tend to change perception of the company somewhat. And so the trading price will likely change somewhat. Usually not that much, but sometimes a bomb will drop and the stock will trade at 8% higher the next day. But by doing it when the markets are closed, it gives everybody an equal chance to read the disclosure and before making their next trade. Extended hours trading is sort of an aftermarket arrangement where people can still trade securities when the market is closed, but with some limitations and higher risk because not many people do it. So the volume is lower, so the price fluctuations can be extreme and might not represent what the price will be when the market reopens. So I don't recommend extended hours trading, and most brokerage companies probably won't even let you, especially as a new user. So probably not something you want to get into right away. Okay, let's talk about indexes. You may have seen the ticker tape across the bottom of your news when you're watching TV or on the web, and they'll often mention Dow Jones, S&P 500, and or NASDAQ, as you can see across the top of the screen there. These are three very popular indexes. And the news might talk about it and say, hey, the market is up 50 points or it's down 2%. These are based on an index. An index is a large collection of companies that people consider to represent some segment of the market. Some popular indexes are the three you see here. And notice that there's a percent, and then there's this other number that we call points. And so you might hear the news say the Dow Jones is up 2%, or even more often you might hear the Dow Jones is up 56 points. And points alone don't mean much. If you just heard 56 points, okay, what does that mean? Especially given Dow Jones's their absolute value is 31,097.97. Now, honestly I don't even know what that number means. And it's not important to know what it means. What is important to know what is relative to what it is the next day relative to what it was the previous day. So here's an example. If the Dow Jones is 31,097 and it goes up 56 points, that's a 0.18% bump. That means if you were invested in things that follow the Dow Jones in the stock market, then the value of your nest egg has gone up 0.18%. Well, why don't they just say 0.18% then? What do we need this points thing for? So think about let's just say you had $100 and it went down 10%. What have you got left? You've got $90 left. Now let's say it went back up 10%. Now what have you got? Not 100. 10% of 90 is $9. So now you have $99. So if you're going from day to day hearing it's up 2%, it's down 2%, that doesn't mean it was where it left off, because the base of that percentage has changed over time. And so it's hard to know where am I today versus 3 days ago when it was going up and down. But points will tell you that. If you hear it goes up 50 points and then down 50 points, you know you're back where you started. So that's the difference there. Honestly, though, I ignore the points. I just look at the percentages because that will give me an idea of where my money is compared to what it was yesterday, at least. The types of securities. We'll go through each one of these in detail, but in short, a stock is ownership in a single company. A mutual fund is a managed basket of companies. Like somebody else manages it for you. You just buy into the mutual fund and you own a bunch of companies. An ETF is also a basket of companies. It's often defined by a market index, which we'll talk about, and it has some tax differences. And finally, options provide extra leverage at potentially very high risk. And some of these can even make money when the market goes down, which is incredible when you think about it. You talk about how, or you might hear people talk about how these Wall Street fat cats make money when you can make money when the market goes up. That's pretty easy. Making money when the market goes down is also possible. And people on Wall Street can do it, and they can make money either way, which is incredible. And I'll talk about how that works a little bit. But because it's a very high risk activity, we're not going to go into too much detail. So a little bit more about stock. Stock is bought and sold in whole shares, with only a couple of exceptions. This can put some companies out of reach to early investors. For example, if you look at Google's price, this is an old price as of a year ago, but Google's share price was $1,800. Now I think it's closer to $2,800. If you wanted to own a piece of Google, you'd have to have at least this much money and buy in multiples of this amount of money, which if you have $500 a month you want to invest, makes it so you can't buy Google more than once every 4 months. Companies do stock splits on occasion to lower their stock price. So let's say Google decided, hey, well, we want more of the average everyday, working family to be able to own stock in Google. Let's split our stock price. And so their stock price would fall immediately from $1,800 to $900. And everyone who owned a share of stock now owns 2 shares of stock. And so they could split their stock several times in a row and get their stock price down to Microsoft's level. It's important to note that stock price does not indicate valuation of the company. This does not mean that Google is several times more valuable than Microsoft, for example. If the market cap, or how valuable the company is the stock price times the number of shares that exist for that company. And so if you multiply 1,800 by the number of shares Google have, you end up with $1.22 trillion, and Microsoft's valuation is $1.66 trillion. So if you're looking at two companies saying, well, Google's stock price is higher, they must be worth more, that would be an incorrect assumption. Just so you know, that's an important point. Some stocks pay dividends, providing growth or income without having to sell the shares. So in the simplest case, when you own a stock, you don't make money until you sell a stock. So you buy 10 shares of Microsoft, and then 20 years later, you sell those 10 shares of Microsoft at a huge profit. But in the meantime, you didn't actually have any cash from it. The only profit you can make is by getting rid of what you were holding. But the stocks that pay dividends pay their shareholders periodically. So Microsoft several years ago decided, hey, we're making so much profit, it doesn't make sense for us to invest all of our profit back into research and development, and so we're going to just start paying our shareholders that money. And so when Microsoft makes profit, people who hold the shares get a check, essentially. Now, that check usually doesn't come in the form of a check. Your brokerage that's holding your Microsoft shares for you might be configurable. Mine is set up so that when Microsoft pays me dividends, they turn that around and buy more Microsoft shares. So if you started with 10 Microsoft shares and they paid a dividend, you might end up with 10.1 shares, because with a dividend you bought another tenth of a share. Now, I said that shares can only be bought and sold in whole increments. That's true. Dividends is one of those exceptions that I mentioned. I didn't personally buy the dividend. The brokerage used I didn't buy the share, the 0.10 or 0.1%, 0.1 share. But for my brokerage did for me, and using dividends, and so they did the fractional share. That's one of the few ways you can get a fractional share. But you could also then sell off that dividend, that 0.1 share, and get again, you have to sell a whole share. But the point is, those dividends accumulate, and so now you can sell or profit off of your dividends as you go along without ever having sold your original 10 shares, and potentially live off your dividends. But I will say that dividends typically aren't that much. You'd have to own a lot of shares in a company for the dividend to be something you could, let's say, live off of. Checking out stock prices yourself, including market caps and a bunch of other statistics about a company, is very easy. There's lots of websites that can do it. Google.com/finance is one. So we'll take a quick look at that. So here's Google Finance, and you can see just several companies that are large and usually interesting. Amazon has gone up 13%. These are daily changes, by the way. Amazon jumping 13% is huge. That's unusual. You don't typically see a stock jumping by 13% in one day. 3% is large too. You also see some indexes like the S&P 500 and NASDAQ, and here's another one that you may not have heard of. You can see the NASDAQ has gone up 1.58% today. That's a good, healthy jump. I mean, remember, the market goes up on average 10 to 12% per year. So 1.5% today is unsustainable. You won't typically see that. You'll see it going up and down all the time. So here's the daily record for this would have been Friday. This would have been yesterday. So it went from 13,934, their absolute value number, that is just how they report things, to 14,097. But notice, I mean, it was even higher than one. So from this end point to the beginning point was 1.58% increase. At one point during the day, I don't know if that's 2.5%. So this is an example of the volatility of the market. It goes up and down all the time. If we look at a month, in the last month, it has gone down 6.6%. So Friday was a good day when it kind of recovered some of that. And yeah, you had a slope for a couple weeks of just going down. So it's good to see it come back up. If we go 6 months out, again, it's actually gone down in the last 6 months. It hasn't been a great several months recently. Year to date, it's fallen 11%. This is pretty dismal. Okay, so if we look at, well, year to date is short, but by the way, like these periods are getting longer until we get to year to date, because 6 months is 6 months. And year to date is, as of this recording, just over a month. So we jumped back to just January 3rd. So if we look at the last 12 months, it's actually done not well, but it actually made a profit of 1.7% in the last 12 months. That's atypical, but it is, I mean, but it demonstrates the volatility of the market. Some years will be good, some years won't be. Let's look at the last 5 years. So in the last 5 years, it's gone up 1.5x. It's gone up 145%. So if you had $100 in the stock market over the last 5 years, you'd now have, what did I say? 5 years? $10? Well, if you had $10, that would become like $25 in 5 years. That's a lot better than your checking account would do. But you can go in here and you can say, well, okay, how about Alphabet? Let's look at Alphabet. Yeah, so in my slide, it was 1,800. Now it's 2,800. And that was only a year ago. So if we look at 1 year, you can see it's gone up $762. And you can see it was down, and it's very recently recovered substantially some of the losses that it had sustained in January. So that's interesting. It can be fun too to stack these things, so you can compare Google to Apple, and you can throw in Microsoft and see how they're all doing. Now, notice something. These are competitors, right? You'd think that maybe the growth of one would mean the demise of the other. Not so most of the time. So if they all started at 0% gains from a given day in the last 12, we're looking at 12 months here. You see, yes, Apple started out going down. They all went down, but Apple went down especially. And there is a common curve. This is like an ocean wave where there's water in all parts of the wave, but they're kind of following the same curve. And as often happens, they tend to follow each other and even get closer together. So by this point, you can see the actual percentages down in the table below. If I move my mouse, it disappears. But you can see at this point, like Alphabet went up 23%, Apple went up 16%, and Microsoft went up 22%, versus here where it's much, much more extreme. The point is, stock prices, and this is a really key thing, aren't as reflective of the company's value as they are about overall market sentiment. People get excited, whether it's their favorite president is in office, or gas prices are low, or inflation is low, whatever the national or world crisis or situation is, people get excited and they want to put their money in the stock market, or they want to pull their money out of the stock market. When they all put it in together, prices go up. When they all pull them out, prices go down. And because people are diversified, generally speaking, which is a really good thing, that means that when they put their money in or out, it doesn't tend to affect just one company. It affects a bunch of them. So yes, some will do a little bit better than others, sometimes a lot better than others. But generally speaking, the market tends to go together. So let's move on. Mutual funds are great. They are a much, much better vehicle to invest in than stocks, especially for new stock people. That said, like, the only stock I own is Microsoft. That's because I work at Microsoft, and paying me stock is part of their compensation. I don't buy stock in any other company. So I am truly living what I'm preaching here. Mutual funds are great for several reasons. They may be pre-diversified. Now, I've got a whole section of a lesson coming up that will talk about diversification. Suffice it to say, though, mutual funds own several companies. So if one company were to go out of business or lose a ton of money, that wouldn't impact you so much. Now, the reverse is true too. If one company goes up a whole lot, it means it won't impact you so much. But in general, a mutual fund is a much safer vehicle, and it will, on average, it will do as well as the average company, which is not bad. Mutual funds aren't guaranteed to be diversified, though. They can be quite concentrated. So it's very important when you're researching what to buy to look at a mutual fund and see what its own diversification is and what buying it would do to your diversification. So we'll talk more about that later in another video. Mutual funds often have fees that lower the return rate. So when you buy a stock, let's say you buy a share of Microsoft stock and you hold it for 10 years and you sell it. Especially nowadays that most brokerages have no commission fees. Everything, that stock going up in price is just pure profit for you, plus minus taxes. But nobody was charging you a fee for holding that share for you. Your brokerage just does that as part of its service to you. Mutual funds, on the other hand, though, because most of them are actively managed, so there's actually people behind the mutual fund deciding, all right, well, we have $500 million that people have bought into our mutual fund. What stocks do we buy? Let's buy some Microsoft, let's buy some Google. And next week they find out, Google made a bad step. Their stock price is going down. Let's quickly sell and replace that Google stock with Apple stock or something. Just to give you, I'm making up an example, but the point is people are thinking about that the fund managers want their fund to perform well so that they can make a profit, so their owners can make a profit. And so as a fee for them spending their day researching stocks to know how to appropriately grow their mutual fund, they'll take a percentage of the value of the fund every year or every month or whatever it is. That will be true whether the mutual fund made money or not. So let's say that the mutual fund's fee was 1% and it grew 12% that year. So that means you get 11% of the 11% of the gain instead of the full 12% gain. But if the market went down 5%, that means you've lost 6% of your value because they still take out their fee. Mutual funds are very nice, and by the way, it's often worth it. So don't let fees turn you off of mutual funds. They are worth their weight in gold in a lot of ways. We'll talk about that more later. Mutual funds are very convenient in that they can be traded with 1 cent precision. So unlike stocks where you had to have $1,800 or nowadays $2,800 to buy a single share of Google, you can just, if you have $495.37 to invest that month, you can just buy that much of a mutual fund. Say, hey, I have $497.35. I want to buy this mutual fund, and you'll get exactly the number of shares. So unlike stocks which trade whole shares, mutual funds can trade in fractional shares. You may have, some mutual funds have a minimum initial investment. So for example, and $2,500 is a common number. So I said, well, to buy a Google share, you have to have $2,800, and mutual funds are much more convenient. That's true. But some mutual funds won't even let you buy your first bit of that fund until you have $2,500 to buy all at once. And once you're in, though, you can put in $50 a month or whatever amount you want. You can take money out, and they don't have trading restrictions on that. I think some mutual funds also have trade commissions. So when you actually sell it, they're going to take $20 out or something. And finally, stocks, when you buy and sell while the market is open, those trades can happen immediately. But mutual funds, those trades are executed at the end of the business day for the stock market. So the 4 p.m. Eastern. That's important to realize. If you have $497 to invest, you place a buy order on the mutual fund for $497. You don't know what the price will be. You just know how much value you're going to buy of it. So you say, I have $497, please buy this mutual fund. At the end of the day, plus a few minutes or whatever, the brokerage will send you an email saying, congratulations, your $497 bought you 13.586 shares of this mutual fund. And the value of the fund, or the price of one of those shares, changes in day increments based on the price at the stock market at the close of that day. So when you buy, you don't know exactly how many shares or what price per share. And that's okay. You're still going to get $497 worth as of close of business. ETFs, very similar to mutual funds. but they, at least in my experience, they're a basket of companies that track an index. So you might say, well, NASDAQ does great. Like in general, I'm happy with a NASDAQ ticker. Like it goes up 12% a year. That's great. Can I just buy the NASDAQ? You can't, the NASDAQ is think of it, it's a piece of paper with a list of several hundred companies on it. Just think of it that way. You can't buy the piece of paper, but the piece of paper is free. It's a list of companies. So you could go through, literally speaking, and buy the right number of shares of each company from that list, and now you've bought the NASDAQ. But the NASDAQ changes which companies are in it once in a while. And when I say NASDAQ, any index. This is true for any index. So the ETFs and even some mutual funds track indexes. Literally, the makeup of companies that they buy into is dictated by whatever the index document says. And that makes it easy. And ETFs, because they tend to track an index, they're basically run by computer. There's no live person manager that's deciding what to buy and sell. Computer's just executing on it based on what the index defines. And so there's little to no fees for many of these index tracking mutual funds or ETFs. And again, ETFs, in my experience, just tend to be doing this. But the real key difference, a real key difference between ETFs and mutual funds is internally the way they're managed is a little differently. So there are tax differences. And what I've heard, and you should talk to a tax professional about this if you're curious or you have a lot of money that it would make a big difference. ETFs are more tax friendly. Mutual funds have some kind of a churn inside where they buy and sell stocks, and that ends up costing you paying taxes because you're kind of by proxy selling and enjoying profits, whereas ETFs somehow evade that. I think, don't take any of that as gospel, but suffice to say, holding an ETF long period might be more tax advantageous to you than holding a mutual fund. Besides the fact that ETFs, again, tend to have lower fees than mutual funds, again, because they tend to track indexes. All of these are just tendencies that I've noticed. They're not guarantees. Whatever you buy, ETF or mutual fund or anything else, you should absolutely read more about it. And in the next period, we're going to talk about, I'm going to show you how to research ETFs and mutual funds. And I'll point out where you find fees and other types of, and return rates and things so you can make a good choice about a mutual fund or an ETF that's right for you. When they do track the index, though, an ETF or mutual fund matches the market performance by definition. If the NASDAQ is up 3%, so is your ETF that tracks the NASDAQ. Okay, types of accounts. Now, when you are in the stock market, you have a login, a username and password with a brokerage firm of some kind. Maybe that's even your bank. Maybe, if you've got an account with a checking and a savings account, that same bank might offer you a brokerage account, and you could use that. I personally recommend getting a brokerage account with a dedicated brokerage firm. The banks that I've worked with, yeah, they might let me buy and sell stocks, but they don't have all of the research tools and monitoring tools and trading tools and options that a brokerage firm would have. And so I have some experience with TD Ameritrade, but most of it was years ago. I have a lot more experience with Fidelity. So I'll just say from my own experience, Fidelity as a dedicated brokerage firm has amazing research tools, and that's what I'm going to be demonstrating in the next class period. So when you create an account, say with Fidelity, the first account you get is a brokerage account. And that's sort of your sandbox. You can buy and sell as much as you want, as much as you have, of any kind of security that modulo options, which Fidelity tends to keep you from touching as a new investor because they're so high risk. But every time you close a position, usually by selling the stock you bought, or a mutual fund or something, that's a taxable event. You will owe the IRS capital gains tax when you sell or when you close that position. And you want to be careful. There's a lot of tax implications. You should talk to a tax professional about how to do that right. I've had more or less success with it. Basically, the IRA, they won't withhold, your employer withholds part of your paycheck to pay for income tax. But if you make $10,000 by selling a stock or some security that you hold in your brokerage account, then you owe some portion of that $10,000 that you made in profit to the IRS. And while you could pay that on April 15th, eventually, if you find that you actually owe more than $1,000 to the IRS on April 15th, they get upset and there's penalties that they charge you for not having paid more taxes earlier. So it's hard to get that right, but just be aware if you're going to sell something that is going to be advantageous to you and it's going to be significant, you should probably talk to a tax accountant to make sure that you're not going to do something that's going to cost you penalties. So let's talk about some tax advantaged accounts. So if you are a full-time employee, you might have a 401k from your employer. 401k might be the same username and password login with your brokerage firm that you will use for your brokerage account, or it might be a different one, whatever your employer might offer. Your employer might even give you options. Like Microsoft lets me keep my 401k at one of a few different brokerage firms, so I chose to keep it with Fidelity. And a 401k tip, it's very often that people will put in what's called pre-tax money. So if your paycheck was $1,000 a month and you put 10% of it into your 401k, then what Microsoft or your employer will do is say, okay, here's your $1,000 paycheck. I'm taking $100 out and I'm putting it directly into your 401k. So here's your $900 left, but $900 then has to be taxed. And so I'm going to take out $200 more or whatever you owe in taxes. So now there's your $700. That's pre-tax 401k because they took the $100 out of your 401k before they pay taxes on the rest. Another way to do it is after tax, which means here's your $1,000. Now you owe $250 in taxes because it's on more money than before. So that leaves $750. And then you can still take $100 out and put it into your 401k, but now you only have $650. Whereas before we ended with $700 as your paycheck that you actually got to see. So why would anybody do that? Why would you pay after tax instead of pre-tax if you're going to end up with a smaller amount? Well, when you put money into 401k, if you pay tax on it before you put it in, you won't have to pay tax on it when you pull that money out of your 401k. So it'll be, I won't say tax-free because you did pay tax on it, but you already paid tax on it because it was put in as an after-tax contribution. Most people don't, my perception is most people don't use after-tax money to contribute to their 401k. Many will use pre-tax because that means they get a larger paycheck now. There's another reason, which is when they retire, they anticipate lower income. Or in other words, they'll anticipate spending less money. If you're making $50,000 a year right now, when you retire, you might be able to live off of $40,000 a year, which means you're in a lower tax bracket. And although you'll have to pay taxes because you did pre-tax before, the taxes that you'll pay will be less than you would have paid had you paid earlier when you were earning more money. So pre-tax can make a lot of sense if you're expecting to have lower income in retirement when you're and where income means what you're withdrawing from your 401k. And we'll come back. There's one other option in the 401k that we'll touch on. But first, let's jump to traditional IRA. If you're not employed, or if your employer doesn't offer a 401k, or if you just want to open it, you can open up an IRA, which is an individual retirement account. So that's your own business. You can go to your brokerage firm and open up one, either a traditional or a Roth IRA. Now, with all of these tax advantage accounts, there are limitations to how much you can put in and when and how you can take money out. It's important to understand what those are. And your brokerage firm won't necessarily block you from doing more, but if you do more than you're supposed to do, Then when it comes time to filling out your taxes, you realize, oh crud, I made a mistake, and you have to go fix it. And sometimes there are penalties, like if you withdraw money before retirement age or withdraw too much money or whatever. I don't know what all the rules are. There are penalties, stiff penalties. So you want to absolutely make sure you understand the account you've opened and what its limitations and penalties are. That out of the way. Traditional IRA is it would be, I think you could do pre-tax or after-tax in a traditional IRA as well. And by the way, if you do after-tax in either of these, again, you paid the taxes on the $100 you put in, but then it grew over time, right? We want compounding interest. The point of investing is so that it grows. So let's say that $100 over the course of 20 years grew to be $1,000. Well, you only if you put it in with pre-tax, you owe taxes on the full $1,000 when you withdraw it. If you did after tax, then of the $1,000 you have, 100 can be withdrawn tax-free because you already paid taxes on it. But the other 900 that grew, that you haven't paid taxes on, so you have to pay taxes on it as you withdraw it. So if you withdraw $500, you pay taxes as if you had been paid $500. Now, it's absolutely worth talking about a Roth because Roths are magical. They might be right for you. So I'll give you a rough idea of what my rule of thumb is for it, but it may or may not apply to you. Roths are a form of after-tax for which you do not pay on the growth. You don't pay taxes on what grows. So let's go back to this after-tax $1,000 example. I put in $100, but it's into my 401k or my IRA, if it's a Roth IRA. I put in $100, which it's after-taxed. So I paid taxes first, and then $100 that I had left after paying taxes, I put into my Roth. That then grows over 20 years to be $1,000. It's all tax-free at that point. I can withdraw the full $1,000 all at once, and I don't owe a cent to the IRS, provided I did it when I reached legal retirement age, which I think is 59 and a half at the moment. That is amazing that you could have $900 be totally tax-free, completely. You've never ever paid taxes on it. Now, Roth IRAs are so incredible that way. I don't know of any other vehicle in which you can accumulate wealth and have never paid taxes on it. And anybody can do it. To contribute to a Roth IRA, you have to be employed self-employed. There's other ways of achieving this sort of thing. You can't just put gift money, like if you're living in your parents' basement and you don't have a job and they give you $500, you can't put that into a Roth IRA. You have to show that it was money you earned. So that's my perception of it. There are restrictions and there are concerns. I would be tempted to say, well, shouldn't everybody do Roth IRA? That's amazing. Well, remember, it's a form of after tax, and paying after tax doesn't always make sense to people. If you're investing money that you don't expect to grow significantly because you only have 5 years left to retirement, for example, and you expect that when you retire, the amount of money you'll be consuming will be much less than you are now, then paying after tax doesn't make sense. Pre-tax would make a lot more sense because you'll get a bigger paycheck now, and when you pay taxes later on what you invested, it won't have grown that much, and so it won't be significantly, and because you're in a lower tax bracket, you'll end up paying less taxes and having more money. Then there's giving. Maybe you know that you're saving up enough and early enough that you're going to have more money than you need, and you're looking forward to giving to charities a lot in retirement, which would be a wonderful thing and a wonderful goal. Pre-tax money is amazing for that because let's say I put in that $100 as pre-tax money, and then that grew to be $1,000. That is all 100% tax-free if you give that $1,000 to a charity, to a 501c3, which is, whenever you donate to 501c3s, you get to write it off your taxes, right? And so at that point, you didn't pay on the 900 and you didn't pay on the 100. So it's even better than a Roth, which you would have paid taxes on the 100, and sure, the 900 grew tax-free, but you donated to a charity and you had already paid taxes on a little part of that. So if you're going to give to charities, the very, very, very best thing to do is to put it into a retirement account as pre-tax money if you're going to give it away during retirement. Personally, my decision has been if I have plenty of time before retirement that growth will be substantial, I'm going to go ahead and put everything I can into a Roth instead of pre-tax, even though I look forward to being philanthropic, because I want my philanthropy to not be limited to what the government decides is a worthy charity and not christening it with a 501c3. I'd like to be able to give money to my neighbor or to my, whoever needs money. I'd like to be able to give it mostly tax-free without, well, you're not a 501c3, so I can't give to you because then I'll owe a bunch of taxes. Like, I don't want to have to deal with that. But that's a personal decision I've made. And honestly, I do have some pre-tax money, and it's just a balance of what you're comfortable with. Finally, 529s is a nationwide tax advantaged account that is good for saving for education. I think you put it after tax dollars into it, but then it grows tax-free as long as when you pull the money out, it's for educational purposes. And that could be for your kids, that could be for yourself, for continuing education. So that's a great option to look at. You should talk to tax professionals or brokerage people at the brokerage firm that you have an account with to find out if there are even better options. And there are so many tax advantage account types that I am not listing here. And you should find out what they are that might apply to you. I live in Colorado. And so if Colorado has their own account type like a 529 that has the same national benefits, but even more state level benefits, I suppose it probably takes, it allows me to maybe contribute money and deduct it from my state income tax, maybe. I need to look into it more. But just as an example of things that I don't know. And so I certainly can't convey everything to you. You should talk to some professionals who know about all the different account types and what you can do, what their limitations are. And your brokerage firm can help you with some of those limitations. For example, your brokerage firm will block you from contributing too much money to your Roth IRA or other IRAs, limited to two things. The limits change based on your income level, and your brokerage might not know what your income level is, and they might not block at the right level. But they can warn you. They say, hey, remember, you've put in $5,000 already, so this is going to make $6,000. Is that okay? And at some point, I think some of them at least will block. But you should take, especially if you have, because it's legal to have a Roth IRA at Fidelity and a Roth IRA over at TD Ameritrade, but they don't talk. So they would both allow you to contribute up to the limits. But when it comes time to filling out your taxes, you're going to have to report that you contributed to Roth, the full 10,000. If you put in 5,000 of each one into your Roth IRAs, at which point the form will say you goofed. You're only supposed to put in 6,000 or whatever the limit is, and so you have to hurry and withdraw the $4,000 to fix it, and there might be penalties. I don't know what all of the ramifications is of that, but just that's why I say when you have a tax advantaged account, you are responsible to know what the limits are and what the both in limits of contribution and limits in how you withdraw, etc. Now, during one of my classes this week, someone asked me, can I move money or move securities across brokerages? And the answer to that is yes. It's a pain. So if I had a brokerage at TD Ameritrade and I had another brokerage account at Fidelity, and let's say that I wanted to shift from TD Ameritrade to Fidelity, and I had 10 shares of Microsoft stock at TD Ameritrade, I have a couple options. I could just sell my shares at TD Ameritrade and get cash and then transfer the cash to Fidelity, then buy 10 shares of Microsoft stock over at Fidelity. I could do that. But when I sell, that's a taxable event. And maybe I don't want to pay taxes on the gains right now. So what I could do is write a letter, and there's a formal process, and you would call up TD Ameritrade and find out what the process is. And basically send a signed letter saying, I want to transfer 10 shares of stock directly to my account over at Fidelity. And then they have their back-end ways of transferring the record of holding shares to the other place, and then you never sold it. And so you don't owe taxes on that yet until you sell it over at the Fidelity place. Now, like I said, those are two options that I have. Assuming it's a brokerage account. If it's a retirement account, if you sell the securities in your 401k and pull out the money from TD Ameritrade, and then you put that money into your 401k or your IRA at Fidelity and then buy some securities, big mistake. Don't do that, at least until you're retired. Because by withdrawing the money, that is a taxable event. And if you're not at retirement age, that's a big penalty, because you promised by the agreement with the tax advantage account is you won't withdraw money until you're retired. So if it's a retirement account you want to transfer across brokerage firms, that's when you really have to write a very carefully written letter so that they will transfer the securities directly across accounts without selling them. And you absolutely want to be talking to a professional, at least at the brokerage firm, to say, look, I'm below retirement age. I want to transfer this to another brokerage into my new retirement account that's over there. Don't sell. I'm underage. So that they can help you do the right thing. Okay, so we're about to wrap up. The homework for this video is to go and create a Fidelity or TD Ameritrade account. It doesn't actually have to be either of those. Those are the ones I'm familiar with, and I would recommend if you don't have any idea who to create an account with. I will be using primarily Fidelity in future videos when I'm demonstrating how to do research. So if it's all the same to you, picking Fidelity might make an easier choice for you, because then you'll be able to see the same screens that I'm seeing. TD Ameritrade I have some experience with, and I'll briefly show that in some of these videos. If you want to stick with your bank brokerage, you're welcome to do that. I hope they have good research tools, but I won't be able to demonstrate any of them to you. Setting up one of these accounts is free. They probably will ask you for your social security number, birth date, full name and address, the things that for tax reporting reasons and compliance to various laws, they need to know who their customers are. But at your discretion, you can link it up to your checking account so that you can then start transferring money from what you have to spend into your brokerage and then start investing it. At this point, I don't recommend investing it. I've got more videos to show you on how to choose what to buy into. But just so you know, so setting up one of these accounts there's several questions, but it won't cost you anything. And if you don't go and start trading, then you're not at risk of anything either. The other part of the homework is to create an account on the Investopedia Stock Simulator. This is an amazing resource for you. This is very much like a brokerage account, and you can use play money. It's monopoly money. You can give yourself a bunch of money, and then you can do real trades with it, in the sense that it's going to be a very similar experience as when you are at Fidelity or TD Ameritrade or your other brokerage. You can place multiple kinds of orders. You can get a lot of practice and get comfortable with it and how your money changes over time, all with just monopoly money. It's great. And so this is what I would encourage. You should also go and create this. So I have an account, so I'm going to log in. And this is good. This is good. So I created, there are games where you can set up the rules. You can say what the commission prices are, lots and lots of different rules, and you can actually play with people. So by all means, you could get your family together, get them watching these videos, get them to join Investopedia, and then you can all participate in a single game where you set up the rules. And in this game, I gave myself $100,000. And I bought Microsoft. I bought 10 shares of Microsoft, and I paid $300 a share for it. And this was about just a few days ago. Microsoft's stock price has gone up $5 since then. And since I have 10 shares, that means I made almost $50. That's pretty good in just a few days. Yay! And that was not with $100,000. It was like a $3,000 purchase then. Okay, and so you can see the value of my portfolio going up over time. I have an account value of 100,037 bucks. Yay. Now, in this particular game, I also paid a commission of 20 bucks. I don't know why the default games in simulator have $20 commissions, because no brokerage account has an excuse to charge you commissions for buying stocks anymore. They're all free. So if I were to start my own game and set the parameters, I think I'd give myself free commissions. You see my buying power is less because I can't buy more than I have cash for. So I actually have I have $96,000 in cash. And then buying power, this has to do with options and things. You can actually buy more than you have cash for, because I have investments that are worth something, so that if they had to, they could sell this off and make their money back. Don't look at this too much, especially now. We're not going to be looking at options. So you can just focus on, this is how much cash I still have to invest. So go inside of Investopedia, create an account, get some of your family into these videos, help share the knowledge, eventually share the wealth, or at least the knowledge of how to accumulate wealth. Get them in on a game with you. And what I want you to do is start researching. So I can say, well, let's see how Google is doing. So these are not the same quality of research tools that you'll get at Fidelity, for example, but you can still do some level of research and decide, okay, well, I'm gonna buy some Google. So okay, that looks good. Trade Google, buy. I want 2 shares of Google, and it's a market order. So we'll talk more about the different kinds of orders. For now, I'm just gonna say a market order, because that's the simplest one. Day only is fine. Well, again, we'll talk about the details of this later. But for $2,800.65 per share, 2 of them is going to cost me, they're estimating it's going to cost me $5,751. Now, it's estimated. I told them to buy shares, 2 shares, but the market is closed right now, so they can't buy it. So they'll buy it on Monday when the market reopens. And the price of a Google share will be different by then. So they're just telling me about what it's going to cost me, but they're going to buy me 2 shares, assuming I have the cash to back it up, which in this case I have plenty, because I have $96,000. Okay, so I'm going to say submit order. The order has been received. Now I can go to order status, and I see here's the trade I just made. It's going to buy at market open. So Monday morning, as soon as the stock market opens, it's going to place this trade, 2 shares of Google, and away it goes. Now, this is all play money, and it's play shares. I'm not going to own 2 shares of Google. But you'll see over time how that impacts you, how your trade went. Now, there is an enormous warning that I have for Investopedia. These are games, and you can actually look at other people and how they're doing it. So here's a leaderboard of games. Okay, you can see some people are doing. I'm not sure. It's been a long time since I've looked at this. I'm not sure I'm interpreting it properly. Okay, so this person gave themselves $3 billion, I guess, right? But basically, there are leaderboards on Investopedia that will let you look at people who are doing very well. And you can see what their portfolio is. You can see their trade history at every trade they make. You can see it. And the warning I have is, it can be very tempting to say, oh, well, this is great. I get to see into brilliant people and their trades, so I can then take what they're doing with play money, and I can do it for real. Whatever trades they make, I will do. And whatever they hold, I will go and buy that, because these brilliant people who are making a ton of money, more than anybody else in the stock market, more than anybody else on Investopedia, these are the leaderboard people. And it's all open. I can go buy that. Don't do it. I can't overstress that. That would be very, very hazardous. Here's the thing. There are thousands and tens of thousands, millions, I don't know how many people are on Investopedia. And just imagine for a moment, they were all making completely random trades with no wisdom at all. Some are going to perform very poorly. Some might perform okay or not lose or make any money. Some will perform very, very well. And it's not because they're smarter. It's because with random sets of people doing different things, they're going to perform differently. But there is no place more appropriate to apply the stock market warrant disclaimer: past performance is no indication of future results. That is so true here. If you look at the random subset of people who made a ton of money, that is no indication that they will continue to make money. In fact, odds are good they will be next week's big losers, because making random trades will not sustain you at doing well over long term. Now, why do I say these people are doing random things? I don't know. Maybe those are computer bots that are doing random things. Maybe they are real people, but I'll tell you what, if they really were brilliant, they wouldn't be on a simulator. They would be doing it for real. So you can assume everyone in the simulator doesn't know what they're doing and they're just practicing like you. You can look at other people and what they're doing for your own education of, oh, that kind of order, I wonder what that order does. Or I have never heard of that company before, and you could like research it if you want. But don't translate what they do in a simulator to the real world. Don't ever do that. It can be tempting, but don't fall for that. Okay, so I hope this has been an educational and useful video for you. Please consider liking and subscribing, especially subscribe if you want to be notified of future videos. And this is a contiguous course, so the next video is going to build on this one. I do hope you'll invite your friends and family, especially join you in the simulator, but to watch this video as well. Please leave your comments on the video with questions that I can cover next time. And I really look forward to helping you out some more. Have a great week.